America is the strongest, but we need to get stronger and quickly. Time is now. Pause.
The United States is once again facing the possibility of a government shutdown. The US government now owes more than $37 trillion.
What if America's most dangerous crisis isn't war, inflation, or recession, but debt itself? Today, the United States owes more than it ever has, now past $37 trillion. That's more than the GDP of many major nations. And with interest on that debt already surpassing $1 trillion annually, the system is under strain like never before. In this video, we'll explore whether America's hidden debt load is quietly turning into the trigger for a collapse, and how recent shifts in bond markets, U.S. foreign lending, and government policy are accelerating the danger. The headline number is staggering. The U.S. national debt recently crossed $37 trillion. Yet, the more alarming fact is how the structure of debt holders is shifting. Private foreign investors, not central banks, are now major buyers of U.S. Treasuries. That shift raises volatility because private investors demand higher yields, which pressures U.S. borrowing costs. Meanwhile, the Federal Reserve recently cut interest rates by 25 basis points to a range of 4.00 to 4.25%. Markets expect further cuts this year in response to weak job data. But this so-called relief brings new risks. Lower rates might encourage even more borrowing, deepening the debt trap. Also note this: as debt grows relative to GDP, each incremental increase in debt causes more upward pressure on long-term interest rates. Research suggests every 1% increase in debt to GDP could push rates by about 3 basis points over time. How the debt machine works. Debt now fuels much of the U.S. fiscal machinery. Rather than paying down old debt, the government rolls over bonds, borrowing new money to pay old obligations. This cycle is acceptable only if interest rates remain low and confidence stays intact. But given the rising average interest rate on U.S. federal debt, now around 3.35%, more than double compared to early 2022, the margin for error is shrinking. Congress has also passed legislation that allows the debt limit to increase. This effectively gives license to borrow more, not less, without major fiscal reforms. So the question is no longer, can the U.S. borrow? The question is, how much pain must we endure to service debt? The 3 collapse triggers. Here are 3 flashpoints that could convert debt stress into a full-blown collapse. First, yield shock. If market confidence slips, bond yields could spike sharply. That would make even safe U.S. debt payments unsustainable. Given the changing bond buyer base, volatility is much higher than before. Second, bond exodus. Major holders like China and Japan could dump treasuries, perhaps not all at once, but gradually shifting away. Since private buyers now dominate, that shift could accelerate rapidly. Third, debt ceiling and government shutdown. The 2025 budget expires soon. A government shutdown looms, and if Congress fails to act, the ability to pay obligations is jeopardized. Markets have already started jittering ahead of this deadline. If any 2 of these events coincide, yield shock and investor exit, or default risk and political paralysis, the collapse becomes self-reinforcing. The impact on Americans. You might think this is only about big money and global finance, but the effects reach your wallet. The federal government's massive borrowing competes with the private sector for capital, pushing up interest rates on mortgages, student loans, and business borrowing. The per-household share of U.S. federal debt now hovers around $100,000. Even slight delays in payments or cuts in government services would trigger social unrest, financial panic, and systemic distrust. If confidence cracks, if Americans begin doubting the sustainability of U.S. debt, that's where the collapse becomes self-fulfilling. Why 2025 is a special year? This isn't just theoretical. The year 2025 is shaping up as a pivot year. Investors are watching bond markets more intensely than ever, especially with private buyers dominating. The Fed's rate cut in September is a signal that policy is shifting, but that could magnify risk if growth weakens. The approaching U.S. government shutdown adds uncertainty, delayed data, funding constraints, and political brinksmanship. The debt-to-GDP ratio projections suggest America's borrowing path could push debt held by the public to 120% of GDP by 2035. So 2025 may be the year where cracks start showing, not decades from now. The lines between stability and collapse have never been thinner. If yields explode, investors flee, or the government defaults, the consequences will cascade across the global economy, not just America. So the big question, is America already on the edge of collapse, or is there still time to course correct? Stay tuned, because in our next video, we'll explore debt solutions that could rescue the system or accelerate the fall.